with us today is Paul Ambrosio, who is a reverse mortgage professional himself, lives in Southern California, and he is also a reverse mortgage borrower. So, Paul, thank you so much for joining us on HECMWorld. I know we've chatted back and forth in the last year or two, but more so in the recent months. Tell us a little bit what's been going on since you got your reverse mortgage.
Well, first, thanks for having me, Shannon. So when I got my mortgage, I figured that I might get a couple of calls at some point. We know that there's a 1 year period where you can draw 60%. So I figured when that was over, I was going to get some solicitations, but they didn't wait. Boy, they were on it right away. It started with a bunch of phone calls and then a bunch of direct mail, and they are relentless. I have a folder here of all of these, and it's thick. It gives me a sore arm just to pick it up. But I recently came back from vacation and had 4 or 5 mail solicitations, and a lot of the phone calls I receive that are spam are reverse mortgage companies, and we can get into a little bit of some of their tactics, but yeah.
So recently, I don't know if you caught it on HECMWorld.com. I covered the trigger lead
Yes. Yep.
legislation, which has fortunately passed both the House and the Senate and is going to President Trump for his approval. But I would imagine these would be leads that were, in fact, no pun intended, triggered by your mortgage application, right?
And they've triggered me in terms of
Well
getting
said.
getting bombarded. But
Yeah.
yes, it was from the application. I didn't necessarily see a difference between application date versus funding date versus, I mean, it just was an onslaught from the start, and it still hasn't stopped.
Absolutely. Well, the reason I want to tell your story is not only you as a reverse mortgage professional are experiencing it, but we can just expand this to every homeowner in the U.S. who has a reverse mortgage is getting slammed with these ads, I think is safe to say.
Absolutely. And it's, being in the business, I know what to look for. I know what, is a mortgage company trying to solicit a refi. But my concern is that a borrower, especially an older borrower who may not be as sophisticated, looks at some of these things with deadlines, with important notices, with last chance to act. And they even will often say it's from my reverse mortgage company. So I
Right.
can see how people would be misled.
Absolutely. And this, I think, really tarnishes the reputation of the industry and the professionals listening and watching today who are ethical. These players who are refusing to abide by the rules of the game, I think, need to be stopped in any means possible. So, what I'd like, with your permission, Paul, is can we go over at least 4 of these ads, and we're going to kind of look at these real quickly? All right. So this first one you and I kind of chuckled at because we were like, oh my gosh, it looks like Hunter Biden. So
Yes.
yes. So get a lower interest rate and more money from your reverse. Of course, thanks to the credit bureaus selling our information left and right, they have an approximate date here and drop your interest rate and get some tax-free cash. What are your thoughts on this one? And I'll go over some of the regulations there in clear violation of.
Well, rates have not decreased since I received my loan, so that's not going to happen.
Yep.
I did mine at a rock bottom margin, so there's no real way to improve on that. Um, and more cash, I mean, they have no idea if I've maxed out my line of credit or what kind of value I had on my home, um, the PLF.
Yeah.
They just have no clue on any of that. So for them to say that, they're just trying to get the phone to ring. They just want to get me on the phone to call this number below and start working me.
Get a lower interest rate, which is laughable, as you mentioned, and more money from your reverse. Interest rates for your type of reverse mortgages have come down completely false since you got it in February of 2023. Drop your interest rate, get some tax-free cash. So I did a little bit of analysis on this, and one is this is in violation because it's using trigger terms. They're mentioning loan terms, or amount of credit, and it triggers a requirement for them to conspicuously list the APR, repayment terms, and whether rates may change. And so that is something that's clearly in violation. Misleading terms, Truth in Lending Act prohibits advertising terms that misrepresent the actual loan. There's the NMLS numbers, but the proper disclosures are not in place. Here's another one. It's regarding your loan, and the amount below reflects the estimated available funds. What do you think about this one?
Well, first of all, they often have Cherry Creek Mortgage showing through the envelope, so it looks like it's coming from the lender servicing my loan. They're not smart enough to know that the servicer has changed, so that makes me laugh every time. But an additional 89,850, I have no idea where that would come from. The rate hasn't changed.
Hmm.
PLF hasn't changed.
Yeah.
I'm a year older, but that's not enough to get 89,000. So that's just false.
Flatly false. So the non-diplomatic term I use is these are bald-faced lies.
Here's something else, Shannon. They say that my home is worth 1.5. When I did the loan, it appraised for 1.875. So according to them, my value's gone down, but
Yeah.
I could take out more. Can you explain to me how that's possible?
This is some Enron math. I'm not sure how we work that out. So,
It's that new math.
new math. Yes, I'd like to see them show their work on that. Well, this one I did an analysis, and by the way, just to be transparent with our listeners and viewers, I uploaded a PDF of these ads, Paul, into ChatGPT, the AI agent, and I asked them what regulations is violated, and it did a really good job because I kind of had my own list, but it came up with a few others I hadn't caught. So this one violates the deceptive claims. Basically, it's implying free money, no cost when fees apply. And then also, they're substantiating benefits without providing any evidence. So that's the second one. So we pay your transaction fees. Man, maybe that's a free reverse mortgage. If you want one, just call that number right there. See if you get it for free. All right, here's 2025 LHA. Do you know what agency that is, Paul? LHA? Is that like FHA?
I think it is if you can spell. If you
Okay,
can
all
spell,
right.
then it's
All
all the
right.
same, right?
Oh, look at this. This is very important. This is a HECM review. It almost looks like a tax return.
Yeah.
2025 HECM review. Nice barcode. Atlantic Avenue Mortgage. Yes, I am calling you out. Be proud of yourselves. So this one here says,
They send me
Dear
one a month,
Paul,
these people.
what's that?
These people send me one a month.
One a month.
Yep.
Okay.
Yep.
Well, it says you have not contacted them apparently to
I have
discuss your
not. That is true.
eligibility. So that
That's the only
part's
true
true.
thing on here that I haven't contacted them.
The one truthful statement about your eligibility. So they're claiming you have eligibility, which is a clear violation for a cash disbursement and additional funds you've already obtained from Cherry Creek Mortgage. All right. Due to the change in housing demand in San Diego, the increased value of your home may be eligible for additional funds.
Yeah,
Uh,
the funny thing about that, if I could interject, is
yes.
my home appraised for well above the FHA limit. So whatever my home does would have no effect because I'm capped at the 1.2 FHA limit because my house is worth over that. So what housing demand in San Diego does or doesn't do is totally has no
Irrelevant.
value on this at all.
Yeah. So you already hit the HECM limit.
Yeah.
So this one is in violation of the Unfair Deceptive Acts, or UDAP. Even outside of mortgage-specific laws, it's unlawful to make a statement that's likely to mislead a reasonable consumer. Phrases like "you are approved" or "eligible" or "no risk to your home" are violations. So that is another one in the Hall of Shame. Let's do one more, shall we? And then we'll
Yeah,
we'll
let's do it.
chat a little bit afterwards. So, All Western Mortgage. All right.
Oh, I get more money from these guys. I get 148 grand.
Wow, that's a big swing. Maybe they have different math too. So you may be eligible, at least to say the word may, to increase your line of credit by 148,000. This is nice. And then they have this little table here. Hedge against inflation. Okay.
If I could, Shannon, a funny thing about this one is it says your original home value was 1.965, but now that your home value has dropped 200 grand, which I don't think is accurate, that somehow makes me eligible for 148,000 more in cash. Maybe, maybe if my home value was to drop in half, I could get, even more.
Yeah, man, let's hope for a housing crash so you can cash out.
Yeah, there we go.
Wow, this one's a real doozy. So let's see here. A nice table. So the CFPB has actually had enforcement actions for ads like this. Failure to state the borrower must continue to pay property taxes, which you do in homeowners insurance and
Yep.
maintenance. It suggests that the loan is a government benefit rather than a loan, and it implies eligibility without any mention of underwriting requirements that you have to be approved.
Yep.
So these are just four of the ones of your stack of stuff there in the folder that you've
Yeah, that's
received.
just a brief synopsis of the many.
So we're going to be listing resources. I know you and I spoke earlier on how you can report these specific violations, or if you get something that's shady in the mail. And I also want to ask you, how did you prepare your reverse mortgage borrowers for this onslaught when you would close a loan?
Yeah, great question. So I told them that there's a lot of sharks out there that are going to be contacting you. It's going to be misleading. Just know that if there's anything that can be done to improve the loan you have, I'm going to be contacting you. And if you get a phone call or something in the mail, just call me and have me look at it. Don't make a mistake. Don't let some smooth talker talk you into something that's not in your best interest.
Very well said. So you do warn them, and I think this is too where client, reviews or follow-ups are always important. Have you received any offers for these home warranty policies? I understand a lot of folks are getting those as well.
I have. I have. And I have had friends with reverse mortgages before I got in the business send me things saying, "Oh, this sounds great. What do you think?" And it's like, oh, do not call these people. They are just blowing smoke.
Yeah.
So, yeah,
And this is real abusive. These are our parents, our grandparents, our loved ones, our friends. And it is hurtful to see that older homeowners are being taken advantage of in this way. And it's not limited, obviously, to reverse mortgage solicitations, but we definitely want to put the kind of eliminate these if possible, or if not, at least reduce them greatly. So, anything that any of you listening or watching can do to help your clients report these, do it and report it again and again, because that way the regulators will address the squeaky wheel. This cannot be continued.
I appreciate your thoughts to clean up the industry and to also help the older borrowers who are vulnerable to these tactics. And we all know that's why a lot of it is being done because they figure some of these people are not real sophisticated. Maybe they've got a little bit of cognitive decline and aren't as sharp as they used to be. So maybe they're easy picking. So
Yeah.
yeah, we need to protect them and also clean it up for originators like us who are trying to do a good work, and we don't need to be dragged through the mud with these other people.
Exactly, because the longer these ads persist, it's a stain on our industry.
Yes.
Yes, it is. Paul, thank you so much, and congratulations on your reverse
Welcome.
mortgage.
You're welcome.
If you have borrowers living in the states of California, Florida, or Louisiana, you're going to want to watch this next segment very closely. This comes from Housing Wire, and it says that experts are warning of a cycle of doom. That sounds apocalyptic, as disasters are overwhelming what is called last resort insurance. And so those are the states impacted. Let's see what they have to say. A growing number of U.S. homeowners are finding that their only property insurance option is the option of last resort. These are the state-funded insurance programs, such as the FAIR Plan in the state of California. And data is increasingly revealing that Extreme weather events and also climate change, they say, is driving public insurers from these high-risk areas prone to natural disasters and hurricanes, flooding, and wildfire. So if you've wondered what the FAIR plan stands for, it is the Fair Access to Insurance Requirements Plans. And what it does is it gives limited coverage for properties that have been declined by private insurance carriers. And many of those insurance carriers have already left many areas of the state, and that has further worsened the program, and it has driven more people into these last resort programs that are run by each respective state. So one of the things that insurers try to avoid is called adverse selection. In other words, you don't want to be attracting insurance clients or those that are your insured policyholders that are more risky, because that's the adverse selection. They're more likely to have a claim. But that's precisely what happens with these FAIR plans or insurance of last resort, because these are folks that are obviously in a risky area that the private market has declined. So that has increased the risk, and there's going to be more payouts. So the more individuals you have flocking to these last resort plans, the greater the payouts will be, and of course, the corresponding risk. And here's something that very few homeowners know, and that is when these FAIR plans or insurance of last resort find themselves running short on cash, they'll pass on that cost to private insurers based on a proration of their market share in a given area. But it says insurers sometimes pass, I would say almost always, will pass those costs on to their existing policyholders through what are called surcharges, and that further exacerbates the affordability of homeowners insurance in the private market. Fed Chair Jerome Powell recently warned that mortgages in some areas may become what he says nearly impossible to obtain if the withdrawal of insurance carriers continues. What the Fed chair is saying is that if home buyers are unable to secure homeowners insurance, either because it's unavailable or unaffordable, that could be a domino that could lead to increased defaults and falling property values. And that is one thing we don't want to see happen. In one state alone, Louisiana citizen exposure, the total insured value increased more than 4x from 2017 to 2022. Of course, that would be fueled by Hurricane Laura in 2020 and Hurricane Ida in 2021, which hit Louisiana. Now in California, we've seen exposure more than triple, because that is tied to increased wildfires, and nearly 90,000 new enrollees joined California's plan of last resort just in the first half of 2025. That just shows us how pronounced this crisis is in California. So if you lump it all together nationwide, these policies have almost doubled between 2018 and 2023. When you factor in 2024, I imagine that number would be even higher. Housing Wire notes that climate change has also presented a real challenge for both the private market and the FAIR plans, because when they set rates, they're based on historical weather events and conditions. But with climate change, they say that is becoming increasingly difficult. And when we see more natural disasters in a given area, of course, then they're trying to catch up with increases in premiums. As we wrap this up, I did a little bit of research, and I came across a column in the Financial Times on this subject, and it warns that beyond the individual homeowner, there is a bigger financial ripple effect. And that's because as insurance becomes increasingly difficult to obtain or more expensive, it undermines the mortgage market. And without homeowners insurance, people applying for a mortgage are not going to be able to qualify. But for seniors who are using a reverse mortgage or have one already, risking the loss of their reverse mortgage line of credit, or even worse, going into technical default, can be devastating for them. So we want to make sure that we are communicating very clearly with reverse mortgage borrowers the requirements needed for homeowners insurance, and that they also have a plan in place should they see their premiums increase dramatically. This next column came to my attention from James Veal. He is one of the guest columnists at HECMWorld.com. He just posted, in fact, last week. You want to check that out. But this could be a game changer. We have a recent court ruling that is impacting home equity contracts, or as they call them, home equity investments. And let's dive into the details real briefly. It says that on August 7th, the Ninth Circuit Court of Appeals issued a decision on the Olson versus Unison case. Now, if you've heard of Unison, they're an equity sharing company. We've covered them here on HECMWorld. And this was after oral arguments were held in October 2024. So the Ninth Circuit Court of Appeals agreed with the homeowner that, in essence, their homeowner agreement was not a real estate option contract, as had been previously argued, but instead, it met the definitions of what Washington state classifies as a reverse mortgage and would be subject to their consumer finance laws. This could have far-reaching impacts beyond the state of Washington, as other state attorney generals and regulators are looking very closely at these equity sharing contracts. So here are the particulars of this case. It says that Charles and Janine Olson, longtime homeowners in Kent, Washington, by the way, that's where I attended high school, received a flyer from Unison Agreement Corporation back in 2019, and it was pitched as a way to tap into their home equity. They would get a lump sum of about $64,000 plus. Of course, no payments would be required, no interest, and no added debt. And that's a very key phrase we'll get to in a moment. In exchange, Unison would have an option to purchase 70% of the interest in their home or their appreciation for a set price of $194,000 when certain events had occurred. That would be the sale of the home, death, or 30 years had expired. Now, the agreement was secured by a deed of trust on the property, so if the home did appreciate, Unison would stand to share in the upside of that home appreciation. But if the home's value fell, then their return would be less than the initial amount that they had actually advanced. The Post notes that several years later, the Olsons came to the realization that, hey, with our existing mortgage and this Unison agreement, if we were to sell our house, we would stand to get nothing. That led to them filing a class action suit in 2022, and they argued that Unison's product was essentially a reverse mortgage and subject to the laws of that state. However, that case was moved from the state to the federal courts, where a district court judge dismissed it and said basically that they agreed with Unison that it's not a loan but an option contract, and therefore is not subject to the same rules for other loans in the state of Washington. The crux of the case is, are these home equity sharing arrangements or contracts really a reverse mortgage by another name? Well, for Washington state, they define a reverse mortgage as a non-recourse consumer credit obligation secured by a mortgage or deed of trust, where repayment, principal and interest, and shared appreciation or equity is due only after certain events. Now, there is a deed of trust with these Unison or equity sharing agreements, but there is no mortgage, of course, because these are shared appreciation arrangements. But Unison argued in saying that they are not a loan or credit obligation because the Olsons are not required to pay anything back unless certain events happen. Well, that's exactly what happens in a reverse mortgage. There's no required payments unless certain events happen, such as violating the terms of the loan or defaulting by not paying property taxes or homeowners insurance. So there is a similarity there, and the courts disagreed with Unison and said that the economic reality, in other words, the end result of this contract, is that the Olsons were advanced money, but they do have to pay it back in the future if there's any appreciation or gain in the home's value. So if you're given a lump sum of money and then you're told that you can repay it, but you're obligated to repay it to us at some point in the future, that sounds like a loan. And here's one thing that really drew regulators to Unison and other equity sharing companies, and it's the claim that many argue is deceptive. The claim that these agreements are not debt. There's no debt, there's no loan, there's no interest, which could lead one to say that, hey, I'm not really going to have to repay this, even though they're told that they are. And the court made a point to actually quote one of Unison's advertising flyers, which claimed that if the value of the home went down, they incurred a loss. But then the court went a little further and dove into these scenarios, and they found that the property would have to drop in value or depreciate by 25% before Unison would be in a position where they would lose any money. The column does note something interesting, and that is under current Washington state law, there's no statutory damages that have been defined per violation, so they suspect that the plaintiffs are going to have to show actual damages that were suffered. Another result could be the death knell for these equity sharing companies like Unison and HomeTap and others. If the plaintiffs were able to persuade the court to void all of the Unison contracts that were originated in the state of Washington, because that is the location of record, they would do so and demonstrate to the court that they didn't obtain a license, so those contracts were in fact null and void, because if they're ruled to be in the end alone and they didn't have those licenses, that would be one way they could void those particular contracts. But what do you do with the funds that they received? In this case, for the Olsons, over $64,000. In conclusion, this story just reminds us that innovations in home financing are good as long as they're well thought out and they're meeting the regulations and the consumer protection laws of each state and, of course, federally. In this case, I think the real issue is that these companies communicated to the homeowners that it's not a loan, when I would believe, and perhaps the court will agree ultimately, they are, in fact, a loan or debt obligation.